Hi, good morning, and thank you for attending. Why banks sell mortgage loans at massive discounts, the hidden market most investors never see. Thanks for joining. My name is Joe Bettag with Benjamin Capital Group, and I'm privileged to have two very seasoned veterans in this business, Todd Billings and Tom McCarthy, who right now is Todd Billings Jr. on our on our call. I had a little bit of a technical issue, but that's Tom on the right side there, Todd in the middle. So anyway, I'm your host, and I like to. We got a lot to cover today, but I'd like to first have Todd and Tom talk a little bit about their background experience, and then we'll dive into to some of our discussion items. Go ahead, Todd Senior.
No worries. Yeah, well, pleasure. Glad to be here, and thank you for joining today. So, I'm Todd Billings. I am a private equity manager for a company called USDV Capital. USDV stands for US Debt Ventures. And we got started in the distressed, non-performing mortgage space back in 2009, which was an amazing time if you had money and connections to get these types of deals. And so we've done 8 funds. We've done about $1.3 billion worth of transactions, done loans in all 50 states. And Joe and I have known each other for probably over 15 years now. And so really glad to be here and happy to answer any questions as we go through our day.
Very good, thank you. And by the way, I know we have some people that's participating, and if you want to go ahead and maybe send any kind of questions you might have in the chat line, we'll try to get that too as well toward the end of our discussion. So we've got 8 discussion points, and it's going to be about 5 minutes each on kind of a lightning round on what we're talking about. So the first discussion point is going to be, why would a bank sell a loan at a loss? Banks prioritize liquidity, capital efficiency, and risk management, not maximizing every loan. Go ahead, Todd.
Yeah. So, at the end of the day, it comes back to what business do you want to be in? Banks are in the business of taking in deposits and lending that money back out, and then charging fees for all of their services, whether it be convenience fees such as ATM fees and wire transfer fees. I'm always surprised that many banks want to charge me to send money to my account. And so the bank business is a fee-driven business and is not a workout business. And that's the business we're in, the business of taking things that didn't work out as planned, which was I'm going to make a loan to a borrower and they're going to pay me every month and then pay me back. That's what banks want to do. But the actual work of someone not paying is a very complicated world and takes a lot of skill and relationships and connections to get that right. And banks, although they could do it, that's not what they want to do. And so they choose to be in a business that's completely different from managing non-performing mortgages.
And Tom, go ahead and introduce yourself. Give us a couple of minutes as far as your background, and then if you can help us with that first topic.
I absolutely would be happy to. My name is Tom McCarthy. My background is I ran profit centers for a publicly traded company that bought distressed assets for a number of years, reporting to the president. A few of those years, we were the largest buyer of distressed assets in the U.S. So I've had a number of years experiencing as a principal, a buyer and trading, et cetera. I also ran the loan sale advisory group, reporting to the chairman of a real estate investment bank, the Carlton Group, out of New York. We advised on the sale for many clients, investment banks, Goldman Sachs, Morgan Stanley, Citigroup Capital Markets. We ran a lot of national banks as well. Regions Bank, for example, at one time was a large client. So I've had a lot of experience as an advisor. In the advisor capacity, we would solicit from banks, and we would solicit business from banks, and banks would tell us why they would or wouldn't sell. And amongst the reasons that a bank would take a discount on a loan is the fact between regulatory pressures, between the fact that the timeline of them holding the loan to foreclosure, sale of the property, whatever, is long nowadays, and they don't want those assets lingering for long periods of time. They're also very cognizant of the fact that third-party costs in the management of a distressed asset, not to mention servicing costs. Servicing costs, we had estimated one time, went up tenfold versus normal servicing of a loan when you were managing a distressed asset. So their servicing costs went up. But the math is much more driven by the fact that there are many third-party costs in managing a distressed asset. And the banks are cognizant of that. Those paying taxes, paying insurance, paying to mow the lawn, paying an attorney to foreclose, the administration of the foreclosure sale. All those things cost money. And most banks, all banks really, are very sophisticated and know those costs. So if they can alleviate the headache for a market price, even though the market may be a big discount to their book value and even the collateral value, that would be why they would be incented to take those discounts.
It's a great point, Tom. And one thing we want to clarify, when we say massive discounts, that's on a relative basis for what a lot of investors might be accustomed to. A lot of investors, from my experience, will buy REO listings where there might be, typically a 5 to 10% discount off of a retail value for a margin of profit. And here we're talking about better discounts, but it's not like, it's generally speaking, we see profit where we're buying non-performing loans at a 50 to 70% discount relative to the current collateral value. That's the kind of quote unquote massive discounts we're talking about relative to what the marketplace might be accustomed to. So I just want to make that clarification as far as what we're talking about in terms of the kind of numbers.
Yeah, and Joe, before you move forward, I think, for the audience, because everyone's at completely different levels of knowledge on mortgages and real estate. So can you just explain to the audience, or one of you explain to the audience, the difference between, what is an REO, like what that actually means to a bank, and maybe just the categories of where, going from a performing loan, there's categories in between there all the way to REO. Could just give some kind of breakdown so people have an understanding, because it's not common knowledge for most.
Okay. Tom, do you want to jump in on that one?
Sure. Well, REO, starting from the back and working forward, REO is real estate owned. Not bank portfolio like their buildings, et cetera, but rather real estate they acquired in the process of foreclosing, or a borrower giving back a piece of collateral to the bank. So it's actually their ownership of the real estate, not the loan itself, not the UPB, unpaid principal balance. What happens is that banks capital accounts are only given credit for certain. REO on a bank's balance sheet is anathema to them. They don't want it. They actually don't buy it either. They won't buy REO. They'll buy a loan, but they won't buy REO. So banks, when they're scrutinized by the regulators, don't want real estate owned, et cetera. They want to turn those over quickly. And to be honest, on REO, and an observation we always made was, if a loan makes it to REO and you're managing your portfolio well, that usually means you've been adversely selected. Ideally, you would make an intelligent decision to resolve the debt prior to it getting to REO. We used to look at REOs as either a failure on our assumption or to communicate options to the borrower, et cetera. Don't get me wrong, every portfolio that's managing distressed assets ends up with REO. But that's not that's not the target or the goal. Too many naive buyers price things just to get to the REO, thinking they want the real estate. The astute manager, and I think Joe and Todd are exhibits A and B on that. The astute manager of a portfolio will manage those assets to get the best optimal solution at any point in their ownership. A shortfall payoff, a sale to a third party that has a particular interest in that. There are many options to restructuring of the loan to resell it to a. I think the optionality and the value of those restructures are maybe a little less than they used to be. But that said, they're still worth a lot of money, and it's still going to be more than the purchase price of the loan. So UPB would be unpaid principal balance, but that would not include all the accrued interest and other fees that might be due from the borrower during the course of it. Items tend to trade in discussions off the UPB, unpaid principal balance, in discussions, but in fact, all those variables may or may not be relevant, the accrued interest and all that. Banks stop accruing interest after 90 days. of a default. So they have no, then they know it's presumed, whether they like it or not, that they won't be collecting any more interest until the loan's resolved. So to recap, UPB is unpaid principal balance. Total debt, though, would include the interest and other fees that were due under the agreement to the bank from the borrower. And REO is the real estate owned after it has been foreclosed upon by the bank or provided back to the bank as in lieu of the debt.
That's a good explanation, Tom, and that kind of really ties into our next discussion point, which is what happens when a mortgage goes into default. So we've already kind of touched upon that, as far as the loan life cycle from missed payments to resolution. So let's talk a little bit about the front end. That was a good explanation on the back end, as far as in today's world. Tom and I, by the way, as a side note, worked together at Aquin. I was there from '97 to 2002, and I've known Tom for that long. But talk about the front end and how things have changed on this credit cycle versus the past credit cycles, where lenders could actually start the foreclosure process much sooner than that 90 to 120 day timeline that's involved in today by today's standards. Can we talk a little bit about what happens in that front end in terms of that first 30-day default, and then what happens from 30 days to 90 to 120 days as far as that process?
Yeah, I mean, I'll start on the higher level, and then I'm sure you and Tom can dig deeper, because you guys have been at Aquid and probably know much more about the servicing component than I do. But I still make loans today, so the way I look at it is the life cycle of the loan is, you need to originate the loan. I need to find a borrower, or a borrower needs to find me, and we need to agree that this is a loan that we want to make. And, if it's a consumer loan, that means we also now, since the crisis, we have a responsibility as a lender to make sure that the borrower has the ability to repay. And one of the main reasons we got into the big cycles or crashes over probably almost every cycle is not paying attention to borrowers' ability to repay. And I think that's where, at the end, to kind of get you to where we're headed, is whenever borrowers are put in positions where they cannot repay a loan because of credit card debt, car debt, any other debt, it creates an opportunity for investors like us. And it is a distress challenge for banks that we're talking about. And so the beginning part is just, hey, did I make a loan? And that's one of the biggest challenges, and I'm sure we'll talk about it today, is, as you get into the servicing cycle, everything starts with, did the borrower's rights or were the borrower's rights protected in the beginning? Because that would be the biggest risk that I see as an originator of a loan, is that somehow I messed up in the way I either originated the loan or in the way I serviced the loan, meaning I somehow violated that borrower's rights. And so that's very different than it was before the crash. And I think that's why we got into the situation where you had these, what they called them, like ninja loans, like no income. I forget the remaining of it, but it was like no one had income. You just had to write down what you made and you got a loan. And that works when real estate is always going up, because, if you do take back the property and it's worth more next year, maybe it's not a big deal. But it all ran into a big crash. And so now I think maybe one of you can take from that loan being, let's just assume it was originated properly, so we don't have any of those. That a good asset manager on the distress side does their due diligence to make sure, when I buy that loan from whatever bank, let's make sure that this loan was originated properly, meaning borrower's rights were protected. And number two, it was serviced properly from the moment it was taken over until the moment it was originated until now when I buy it. And so I would say those are the things I look at as both an originator and as an asset manager who goes out and acquires these loans. And maybe you guys can talk through maybe a little bit more of the details of that 30, 90, 120 day cycle before you actually go into the full foreclosure process.
That's great information, Todd. I'll just jump in real quick. From my perspective, the biggest difference from the last cycle versus this one is the utilization of loss mitigation, in particular loan modifications. We're seeing a lot of that in today's world, and the one thing that we're picking up on is for conventional loan modifications since COVID, there's no underwriting. And to me, that's going to be the biggest surprise in the market. If you and I've had access to some information that's kind of proprietary in nature, that if you that I've got a report that shows that for the largest loan servicers and banks in this country, the UPB, unpaid balance, relative to their delinquencies, it's at 10% right now. And a lot of that's because these continual loan mods that keep failing, but they keep that in that status over and over and over again, and don't allow it to go to foreclosure. That's the biggest difference that I see in this cycle. And that's, to me, it's unsustainable. Tom, can you jump in? And then we've got to move on pretty quick to the next topic. Do you have anything to add?
Okay, I'll be fast.
Yes.
I will reinforce what Todd and Joe both said. Compliance is very important. If you're compliant, your options as a loan asset manager go way up. A lack of compliance handcuffs you and is a panacea of problems. I will say this. The key is to engage the borrower in discussions to flesh out all options. And we used to say we had an inverted bell curve on the cycle of that, meaning when you initiate foreclosure compliantly, everyone comes to the table, they want to talk to you, if they're ever going to talk to you. The other side of it is, at the end of the cycle, when the foreclosure sale is imminent, everybody wants to talk to you, if they ever wanted to talk to you. So collapsing that foreclosure timeline legally with attorneys familiar with the space, foreclosures, compliance foreclosures, et cetera, and notices to the borrowers, et cetera, is very, very important. But that cycle is what's the catalyst oftentimes to negotiate the loans. And so I think foreclosure is more of a tool than an end game, in my opinion.
Yeah, I agree. And I know we need to move on, Joe, but I totally agree with you there, Tom. What I found was we had to really just have human discussions, not you owe me this much, how do you want to pay it discussions, which is what was happening with many of these, because remember, like special servicing, is not the core business of these banks. It's just making sure people make their regular payments. And if you let those customer service professionals handle the calls, you're not going to get anywhere. So you really have to get, like Tom is saying, you have to get down to the details of what's going on. And what I used to tell borrowers all the time was your best offer on that bell curve is in the beginning, because if I have to spend all the money, I have to go to court, I need to recover that. And clearly you didn't want to work with me. Now, there are people, because of circumstances, you work with them because they need their home, but it all starts with having a good discussion. And I think that's really being a good servicer. It's like, hey, let's find a solution. And I found there were about 30 to 40% of people will just bury their heads, and you're not going to get anywhere, and you need the tool of foreclosure. But as Tom said, that's not our ideal choice.
Yeah, great point. So number 3, why holding a bad loan can cost more than selling it. We kind of already talked about that in various ways. We've talked about legal costs, servicing expenses, regulatory capital, and time. Is there anything to add, or should we move on to the next topic?
Well, I think that is the math oftentimes that people are weighing against the sale, is that, and the last item of holding the bank would be the rate. I'm sorry, I jumped in. No one called on me, but Tom McCarthy. The regulators are looking at non-performing loans at banks. It's a preoccupation. So there's the soft element of it. May not be a math issue, but they're bearing great scrutiny from the regulators as non-performing loans go up, compounded by the fact that if they hold it to resolution at the end, an REO sale, that's a long timeline, a lot of money, third-party expenses, and that's why they entertain selling more quickly.
Yeah, and the other thing I add to that is reputational risk, right? When you put your money in the bank, most people are putting their money in the bank because they want it to be safe, right? And so if you are not familiar with the details of non-performing mortgages, and you hear that my local bank that I'm depositing my money in has a large book of non-performing loans, that would make me concerned and make me say, maybe I'll take my cash from your bank into another bank that doesn't have so many non-performing loans. Because remember, banks make money from the loans and getting repaid. So they're literally taking the money that we're depositing, and then they're lending that money back out. And we could probably talk about fractional reserve lending, and that's probably what we're talking about with the regulatory pressure, because they can do more business with, they'll make more money doing good loans than they would ever make recovering money from a non-performing mortgage because of the Federal Reserve fractional requirement. So that being said, reputational risk to me is a huge one, because you have the public out there saying, hey, is my money safe? And it's every dollar that bank loses, the same way they get the benefit of leverage from the fractional reserve system, they get negatively impacted every time a dollar is removed from the bank. So I think that's a huge reason they sell.
Yeah, great point. So we have some great questions coming in here. We're going to get to those questions toward the end of this discussion. So just hang in there, guys. Well, I see some great questions coming in. The only thing I would add to that is, don't forget that when these mortgages become non-performing after about a period of time, the banks have to start moving their profits to their balance sheet for that non-performing loan. So it impairs their profitability and their quarterly earnings. And a lot of these bank executives, their compensation is tied to quarterly earnings, as far as where that stock value is driven relative to their earnings. So there's a financial incentive as well from an executive standpoint to get those non-performers off their balance sheet and do what they need to do. So let's move on to the next one. How banks price distressed mortgage portfolios. Why are loans sold in bulk, and what determines their discounts? Tom, go ahead.
Oh, okay. I would open by saying this: they're sold in bulk for a couple of reasons, not the least of which is that transaction costs. Sometimes they can be laborious processes to sell. Going through a bunch of small sales would preoccupy them, and so there is economies of scale in selling them in bulk. The other reason I think that they sell in bulk and et cetera is that I think they can throw some of it's usually a mix. Buyers sometimes look at these portfolios and say, I'm going to be right on 75% of them, wrong on 15, and 10%, who knows? But I think a lot of times they'll sell in bulk knowing that buyers aren't necessarily going to bear that level of scrutiny. Buyers do, by the way, price every single loan, as Joe and Todd do. But maybe it won't bear the same level of scrutiny. If someone's selling just me 2 loans, I'm going to put a lot of attention on those 2 loans. Someone's selling me 100 loans, I'm putting attention on each one. But let's say I'm not as suspicious that there's something I'm not being thrown a lemon. So I think there's benefit. Buyers are less skeptical of a large portfolio, and banks are cognizant of that. Plus, big banks are making balance sheet moves. It is selling a one-off or two, a couple handful of loans that's a very little benefit to them in their portfolio management.
Great points, Tom. And I might add to that, because that's why part of our model has a trading desk component to it, because invariably when you're doing portfolio acquisitions, that's part of our skill set, is to find those home runs and work those all the way through for the best outcomes. But invariably, on larger acquisitions, there are going to be some marginal deals in there that we're better off putting on our trading desk and reselling for whatever margin we can capture, and then recirculate that capital for that next home run. So that our model kind of ties into exactly what Tom is citing. Okay, let's go on to number 5. Not every discounted loan is a good investment. The importance of collateral, lien position, location, and exit strategy. Go ahead, Todd. You're on mute.
Todd, you're on mute.
Yeah, I agree with what Tom said. Is the reality when you're digging into these loans is you really want to understand if they're small, two loans, you're going to dig into that loan and want to understand everything about each one of those loans. And, the largest loan pool we purchased was 6,851 loans. So can you imagine? There was no way we were going to be able to do the same level of scrutiny on that many loans. And the bank knows that as well. But as Tom is saying, they want to just move these big. Oh, this pool was from one of the top four banks. That's how they get stuff off their books. And if they had to do 6,851 individual closings, that would be horrible. And as Tom is saying, it would also, make me think, if you just sent me one or two loans, am I being adversely selected? Because this loan is not resolvable or something like that. And so I think the job of a money manager like us is to do the homework to figure out where in that life cycle do we believe there should be resolution, because we don't look at it. Foreclosure is last out. That's our backstop. So everything before that is what we're looking at, right? What's the value? Is there opportunity to improve it? What's the borrower situation? Is there a way to, maybe we just resell it? So I bought 6,851, but I know from the beginning, 2,000 of those loans do not fit my box of what I want to do. And there's somebody else in the industry, and all they do is focus on that, and they're really good at it, and they can take those loans, and I can focus on what I'm good at. And so I think as we talk through this, it kind of ties into, our next topic, and the question that came up, Joe, which is, how do investors create the most value during the process? And I think the value is created in two places. One, you're doing your due diligence up front and knowing, hey, have I mitigated my risk? And what do I think the opportunities are? Short sale, deed in lieu, reperforming, selling the loan, foreclosure only, short sale. So you're going to work through these scenarios on each one, and you're going to have a strategy. So when we would bid on a pool of loans, we literally are pricing every single loan. It may look like and to Tom's point, we may say, hey, so don't be confused. And it's easy to get confused when you're speaking to someone who's saying we're getting huge discounts. I'm buying it for 50% of UPB. Let's walk through that for 1 second. Let's say I have a house that is worth $200,000, and we have a mortgage that is, also $200,000, right? Just to keep it really simple. If I say I'm buying it for 50% of UPB, I'm buying it for $100,000, and it means the house is still worth $200,000. I have $100,000 worth of equity. That's an amazing discount. And I'll tell you today, you're not going to find that. So be very careful when you hear these numbers, because you need to also know, hey, it's not just what percentage of a discount did I get from the loan. I need to look at the collateral value and maybe even some other liabilities, like, hey, the house is worth, let's say I still have that $200,000 loan, but the house has dropped in value to $150,000. So now I say I bought it for 50% of UPB, but, the value of that house is really, 150,000. So I bought it for 100. So my equity, my potential profit is now this 50,000. And what I have to run through in the math is, how long will it take me to get to some form of resolution? I have to handicap that as an asset manager. This is going to take me 2 years because it's a foreclosure in Florida and the borrower is burying their head. They haven't talked to the bank not one time in the last 18 months or 10 months or whatever it is. And once I know that and I make an educated guess, then I can price it. And then the second place that we add value is I'll call it towards the end. It's part of that bell curve that Tom is saying. It's like, hey, in the beginning, we're going to do our best. And if you really don't want to work with us, the last part is going to be right before foreclosure, right? And so I'd say we add the most value in those two places. And then I'd say finally, it's not really the loan anymore. The third place is, if you do take over an REO, it comes back to what do you do with the disposition, whether it be on the loan side, capital markets, or it be on the real estate side of having to maybe repair and market a property, which is a whole nother business in and of itself. So there's a few places to add value, and most of it, I believe, is in the front end of the process.
Yeah, those are very good points. One item as far as the importance of collateral, lien position, location, and exit strategy. The one thing that I would kind of add to that, again, part of our secret sauce is the importance of boots on the ground in each local market. Having very knowledgeable default real estate professionals, REO agents and brokers that are well experienced and honest. Let me tell you, when I was at Aquin, I had the toughest region in the country: New York, New Jersey, and Pennsylvania. And I'll just say that I had to sort through and figure out who was honest and who was a little bit less than honest. And just by that selection process, my outcomes were increased by 5 to 10% on my scorecard. So that's critically important. But the most important thing about boots on the ground, from how we manage the due diligence process, is we're getting a value from that local agent to kind of confirm, where we think the value is for that collateral, which is critically important. But most importantly, also, even before we close on that asset during our due diligence process, we're identifying if that property is occupied, if it's vacant. If it's occupied, is it tenant or is it an owner occupant? Hey, if it's an owner occupant, we're going to try to do a deed in lieu all day long to save that money on the foreclosure costs and timelines. If it's a tenant, we're going to offer cash for keys. We're going to find out if there's a valid lease. Again, it's all part of the timeline management, because there's a time value element of money. And that was one of the biggest takeaways I learned at Aquin, was the time value of money and how you cut those timelines down from a management perspective. Tom, can you add anything to that, please?
I would just, a couple quick points. I thought you guys were very comprehensive. We used to always say there's no such thing as a bad loan, just a bad price. In other words, like, it isn't a good investment if you overpaid. But every loan has an inherent value if you do your due diligence. The other side, I guess I would augment this with too, is one should never underestimate the more gestalt view as the market that you're buying the loan in, the direction of the market. In other words, if you know a market appears to be going down, you're actually pricing the value of that collateral sometimes a year later when the foreclosure sale is over, et cetera. So it is important to understand the submarket and even the slightly, the submarkets that you're in, and maybe the direction of what's having it. Did a big company pull out? You don't always know all those variables, but if you do, you need to incorporate it into your rounding up or down of the price.
Very good points. Okay, let's move on to the next topic. How experienced managers create value. Loan modifications, payoffs, short sales, foreclosures, and REO sales. Go ahead, Todd.
Yeah, I mean, I think we kind of talked through most of those things already, and my take is that it really is this word, which is kind of taken for granted, but it's servicing or specialized servicing, right? It's really having all of the things that we're talking about, which is, and this goes back to why don't banks want to do it, right? And why do they hand it off? Because you do have to have a lot of expertise. You do need legal networks, and you do need. I mean, I'm just thinking about when we bought all of these loans, it was everywhere in the country. So very quickly, you have to decide what can we manage and what can we not manage, because when there are bulk sales, banks want to just get their problem off their books, and I have to inherit those problems. So that means I have to price those problems. And the biggest risk in any investment to me is really the time, right? It sounds so simple, but this is a math problem, right? It's a discounted cash flow model for the most part. We're looking, what do we think this is worth? We're going to price it to a net present value so that we can give the bank an actual price that we are willing to pay. And it's worked off of, what I'll say, I liked larger pools because that's where I think the opportunity was at scale. Is like we could do homework that others couldn't do, and we would be able to maybe outbid someone because we just had a little secret sauce. Because I know that market better than my competitor knows that market. I'll give you a good example. The first pool of loans that we bought for 26 cents on the dollar, all of my competition was afraid of it because it was mainly foreign national investors, foreign national borrowers. And when you have a foreign national, meaning they're not a U.S. citizen, the fear at the time was, how am I going to serve them legally if they don't live in the United States? So am I going to have trouble enforcing my foreclosure rights? Right. And what we found in practice, and this goes back to having not only local market, like the expertise around maybe the real estate market, but having market knowledge around the borrowers. Right. So if I'm buying from a pool of borrowers, it's a pool of foreign nationals. What I found in practice, which I didn't know at the time, what I found in practice was many of them are moving money from their countries to be in the United States. They want their money here, not in their current local currency. I had borrowers who were underwater, meaning I had a borrower that, let's say owed me 500,000 and the property was worth 300,000, that they paid the whole $500,000 off, which was not in any of our models. Why would someone do that? American would most likely not do that. But for someone who maybe gets a legal notice or something and may start having fears that, oh, maybe I can't go to the United States in the future. I don't know the legal process in the United States. They get fearful. And many of them were the best borrowers I could ever hope for. It's like, oh, I just didn't know. And so my point is, it's not only having the geographic knowledge, local market knowledge, but it's also knowing, hey, what kind of loans does this bank do? Right. So Bank United was doing a lot of foreign national loans, which would be very different than maybe loans that Bank of America or Citibank or some other, specialized lender may do. So understanding who the lender is that you're buying from and what kind of borrowers they take on is going to dictate what you're going to be able to do later. Right. So like today, I lend money to builders, developers, and landlords. These are people who are trying to make money off of their property. They're less likely to hold on to something when it's bad versus someone who lives in the house. So I could have two loans, both are $500,000 loans, both getting a similar discount. I could buy the one from an investor or one where the person lives in the house. They have very different outcomes, and you have to model that properly to say, hey, which is going to give me the best resolution for the dollars that I'm investing, meaning who's going to give me the most money with the least risk for my investment. So
Very
I know
good
it's a
point,
long-winded
Todd.
answer.
Yeah, that's an excellent point. And the one thing I might want to add to that, getting back to the decentralized local presence, and I found this to be the case when I was at Aquin, when I took over the Northeast region in 1997. At that point in time, here's a good example. State of New York. At that point, Aquin had New York City attorneys and law firms trying to foreclose on properties in Buffalo. Completely different market. The five boroughs versus Buffalo, New York. Completely different process. And so I had to completely change the whole process where, at least at that point in time, I was allowed to have some discretion in finding local law firms and attorneys in each market. And I regionalized the state of New York, where the local attorneys who knew the local judges, who knew the local practices, who knew the shortcuts much better than somebody in New York City that didn't know what the hell was going on in Buffalo or Rochester. And that, again, changed our timeline significantly in terms of cost savings.
Yeah.
That's what kind of really made a huge difference for what we were doing in those particular states. Tom, do you have anything to add?
No, I just think this. I do believe that we used to joke that if you treated a borrower poorly, they took their copper with or the copper piping with them when they left. Basements would be flooded. Also, that's not. We never treated anybody that poorly. That happened, but we that was a true trade-off to being professional, courteous. In fact, the person negotiating with the borrower should not be the one sending the foreclosure notices and things like that. They should become their internal advocate and avail them of all their options. And I think that happens when you're more understanding of the sympathetic to their position, when you're more collegial, when you're less adversarial. I do believe that there's a cliche that you could say win-win. Look, it's business. You are trying to collect as much money as you can, etc. But it's good business to treat the borrower well. And it's good business to have facilitate an open conversation. So that might be that would be one of the things that I might
Yeah.
augment that with.
Yeah, and I really want to highlight a gold nugget that Joe said that may pass by many people in the audience, and he was talking about, you know, risk mitigation strategies in New York and lawyers specifically. So there's a saying as well, and Joe really hit on it, which is a good attorney knows the law. So I'm sure those attorneys in New York City knew the law. They probably know the law better than the attorneys in Buffalo because they probably are handling way more cases and done many more things. But a great attorney knows the judge. right? And so relationships matter. And Joe said that. I'm sure it went right by most people, but that local expertise will make all the difference, because I guarantee you, you go into some of these markets with a New York attorney to take a house from a 75-year-old woman in the Midwest. You're probably going to have a judge that's going to protect that his resident, right? I mean, judges have they have other things to think about versus not. It's not just can you have the right to foreclose. They also have the right to say, let me look at what's in the best interest of my constituents and my community. And guess what? I'm not in that judge's community, right? So pursuing borrower friendly strategies is a non-negotiable in my opinion.
100% agree. Very good points, guys. So let's go on to the next one. Why today's market is creating more opportunities: rising delinquencies, refinancing pressure, and balance sheet
Actually,
challenges.
Joe, I feel like out of all of these, because I'm so far removed from buying non-performing mortgages today, I've done over 13,000 loans here. But the fact is, I think this is a question for you. I know you're moderating, so if you don't mind, I'd love to ask you this one, if you're fine with that, because I think you know more than most of us. Why do you think today's market is creating more opportunities?
Oh, well, okay. I'll take it on. So, I think a lot of it was driven by what happened in response to COVID, from fiscal monetary policies that might have had the best intentions, but all it really kind of did was delay the inevitable and allowed the pressure to build in the background. And I can recite a lot of examples. We had all kinds of forbearance plans. People didn't have to pay their rents. They didn't have to pay their student loans. They didn't have to even pay their mortgages. A lot of the mortgages now that were deferred with the forbearance plans on the conventional mortgages now are added as a second mortgage in the back end of the first at a zero interest rate. And here's the thing: it's not recorded. You don't know the equity position of that homeowner, because that's a silent second mortgage that's not recorded in a lot of those COVID forbearance plans. That's so when you see everyone's equity rich, the people that are saying that really don't know the positions of the individual homeowners. And then, so fast forward to today, now in the last year or so, now we're starting to see the market finally start to work. It's been 5 or 6 years of extended pretend. And the first one out of the gate was FHA. FHA, back in October of 2025, they changed the loan modification programs because clearly there was a lot of mortgage fraud going on first payment defaults that never could be foreclosed on. There was 150,000 FHA mortgages identified by John Kaminsky that met that category. And there was a firestorm on social media, on X in particular, where Scott Turner, the head of FHA, finally kind of caught the hint and radically changed that whole program. So now we're seeing that kind of that pig in the python of foreclosures working through the system, where we're projecting FHA foreclosures to go up significantly the fourth quarter of this year and the first quarter of next year, and that'll be the first large group of mortgages that's going to start resetting values in certain neighborhoods. That I think will have a material effect on where things go in the future. I think
And
that's
Joe,
probably
and what's the increase in FHA foreclosures? What are some of those signals or things that you're looking at that are giving you that kind of direction of rising delinquencies and opportunities in the markets?
well, nationally right now, the default rates for FHA, and that's 30 days plus default, is at 12% nationally. But what's most importantly is the percentage of ones that are 90 to 120 days in default. That's at 6%, which is about half of that mortgage pool. That's significant. VAs around 5%. I still run a REO brokerage operation out of South Florida. We handle Palm Beach County, Martin County, and St. Lucie County. So I see it in real time, boots on the ground, what's going on with respect to the foreclosures. And what I'm finding that's very interesting is that even though we're talking about the largest discrepancy between where sellers are at and buyers are at as far as that gap, because of values and interest rates, insurance and taxes, As far as the amount of national sales are the lowest since 1995. But what happens is with these REOs, it's all about pricing. There is demand at the right price. And a lot of my REO listings are literally selling and going under contract the first 30 days with multiple offers, highest and best type of scenarios because of the price points. And that's what I think as a team that we can offer is affordable housing product to the marketplace through the use of foreclosures if we have to, or loss mitigation, whatever it takes to provide a need to the marketplace that's sorely missed right now. I see that as a great opportunity, not just for us to make some money for the investors, but what this country needs.
Yeah,
Because we're alienating a lot of the younger people in this country, as far as the millennials in particular, that are disgruntled with quote unquote capitalism, and why we see some of the things happening in certain cities as far as the elections.
yeah, no, that's great. You do have one question that is tied into this, specific topic, which is you're talking about UPB relative to delinquencies being around 10%.
Yep. Yep.
The question that has to do with the source of that data, and ultimately, like, how do you make an investment decision from that data? What are you looking at that is telling you like now's the time to start getting in? And we've talked about this a lot already, Joe, as it relates to like the best deal I got was when, right? But I think here the following the data is so important. And so can you just share a little deeper, because you have so much experience and you could probably talk to this as well, Tom, like as you dig into the data, like what data do you actually pay attention to and what is just noise?
Yeah, let me jump in and then Tom can add to it. So Tom and I had dinner with some of the top loan servicing executives about a year ago. I'm not going to mention anyone by name, but they provided some very valuable insights in terms of what we talked about earlier about the amount of loan modifications that keep failing with no underwriting, and as to why the mortgage investors are okay with that, because they're trying to squeeze as much interest income juice as they can. There's equity left in the properties. If they take it early into foreclosure, a third party is going to take them out on the foreclosure. So they're better just trying to squeeze as much interest juice until another outcome happens, as like that person becomes unemployed or whatever. But from my source, I'll just say it's from one of the largest loan traders in the country that's well tapped into that data. Again, I don't have the permission to say what entity it is, but I've got the data. I've got the information, and it comes from a great source. So believe me, it was confirmed a year ago, and then more recently I received that report about 3 months ago, and it confirmed what our conversation that Tom and I had with these executives. Go ahead, Tom.
Well, there are a number of lists available as to what delinquency levels major banks have. So, and one of the rules of thumb we always used to say is a bank that has too many of those is not really a viable seller because they can't afford to be. If there is a hit to be taken from their typically under-reserved position, that might have great consequences even to their viability if they're at the bottom end of that list. At the top end of that list, delinquencies are so little it's not a priority, but it is typically a better idea to track down how many non-performing loans, the dollar amounts, the portfolio mix, what their balance sheet is actually made of, and what those delinquencies are. And those are sometimes targets. If you know that the head of loan sales, the chief risk officers, the CFOs, et cetera, you can sometimes get a conversation with them as to how you can assist with them. I've often thought that, but to answer directly, I'm rambling. To answer directly, I think there are a number of lists that would be indicative of, and as Joe, of distress levels, loans going up. I have a client today, in fact, that handles property registrations regarding that with municipalities when loans go into and their volume is going up as a benchmark here.
And I would think, like, for instance, Tom, how would you, like, let's just take two different scenarios. A group of loans that are going delinquent that are FHA loans versus a group of loans that are, Fannie Mae, Freddie Mac, traditional agency loans. Like just that alone, how do you as an experienced manager just look at that from, a perspective? Like give the audience maybe some insight of just how those two things could be different.
I'm not, I'll be honest. I don't know
Yeah.
every nuanced difference between those two, but I will say this. Um, I do think that both those two types, particularly the FHA, might be sold in bulk more easily than the Freddie. The Freddie Fannie stuff. Sometimes, there's. I don't know that they're as always. I don't know that those portfolios are always as easy to buy as an FHA portfolio might be. Would be one
Yeah,
observation I would have.
yeah. If I can jump in, so Fannie in particular, what they're doing is they're doing NPL bulk sales for 3 states that have long legal timelines involved: New York, New Jersey, and Florida. Each one of those states are judicial type of states, which are much longer compared to, like, say, Georgia and Texas. So that's how they're managing their bad mortgages. Whereas FHA, for instance, you're talking about somebody that only has 3.5% down payment. You can have credit scores as low as 580. You've got very limited savings, so those folks tend to get in trouble a lot faster financially, and that's why you're seeing the higher default rates right now compared to Fannie and Freddie. But if you look at from an historical standpoint in terms of what happens over time for each one of these credit cycles, it's always the subprime that kind of goes first. We talked about the ninjas last cycle. This cycle, it's VA and FHA is a new subprime. But invariably, what happens is over time, as the contagion spreads, as we clearly start becoming in recession, that when it becomes more official, which I believe we're close to it right now, that you start seeing the breakdown on the more higher end type of mortgages. As a matter of fact, I just was on a phone call yesterday with some of the top default professionals on a leadership call, and we were talking about that very subject. Now we're starting to see the higher end million plus mortgages and properties now getting into trouble. So we're seeing that now. We're starting to see that breakdown. I find that very interesting. One more topic, real quick, guys, and then just give me a few more minutes to wrap this up. What sophisticated investors look for distressed credit? Sourcing, underwriting, risk management, and operational expertise. Go ahead, Tom.
Well, I would think most people would want, first of all, somebody with contacts in the industry, experience in the industry, an understanding of the underlying math. That should never be trivialized. There's, running a present value model off a foreclosure scenario, knowing the math of the remaining costs at any point in the asset management cycle, understanding the collateral value, its vulnerability, the math of that, understanding the math of all the third-party costs in the equation while you're doing it. I also think that contacts should not be in a strategy to buy, meaning when I hear about a giant portfolio, I think you're competing against people with lower yield parameters than somebody else might be. And you're competing against somebody that there is a fever to buy those portfolios. You have to be very sophisticated to do that and play that well. That said, being cherry picked, buying one or two assets at a time maybe isn't. But I would think someone that knows the market niche that's less competitive, that can bring somebody to the table that is more of a negotiated or limited competition deal. Avoiding competition is always good business strategy. And I think that to the extent to which the people here, Joe, Todd, and myself, each of us has true contacts established over the years with CFOs, chief risk officers, all the way down to, on some institutions, asset managers. I think those are important if you're going to be helping them out of sometimes they want to dump something before the end of the quarter quickly. They'll come to you because they know you. Those are the things I think that if I'm looking at somebody, someone could have a lot of sophistication, compliance, and everything else, but the relationships and an understanding of the math might be two of the more critical elements, would be my thought.
Go ahead,
Yeah.
Tom. We got a minute or two. Go ahead.
No worries. Yeah. So I would echo what Tom said, and I think it comes down to having your niche. This is a very big space with so many. I mean, this is where the American banking system plays. This is where it's such a big market that the government is the lender of last resort for mortgages. So there's no one, I don't care how big you are, that can do every part of this business well, because if they could, then Citibank, JP Morgan, and Bank of America, they would all just run the whole thing from end to end. They'd run special servicing businesses to end. There'd be no opportunity for us. And so the niche and the opportunity here is that I know what I'm good at and what I can execute at better than my competition can, right? So many times in the beginning, I got opportunities that were not as competitive, right? And that's why you can get things for 26 cents on the dollar. But then later we bought all the way from 26 cents all the way up to 70 cents on the dollar. And in our model, we're still able to hit our double digit targets at 70 cents on the dollar. And we finally stopped going after deals when we were competing against the likes of Starwood and Lone Star, and their cost of capital is so much cheaper. So you now have to be very realistic of who is my competition and do I have some special thing that I can bring to the table that will allow me to make money relative to my competition. Because if you go in there and you're just going to try to buy something and you don't know what you're doing, most likely you overpaid for it.
Great insights, guys. Okay, we got to wrap this up. So, if anyone's interested in learning more about what we've talked about today, you can request our investor guide to distressed mortgage investing through our website, which is benjamincapgroup.com. That's CAP, benjamincapgroup.com. Tom, do you have go ahead. Tom, do you have a second?
I apologize. You said there were questions that we wanted to answer at the end.
We already addressed them. They're closed. The questions are closed. We're good. So anyway, and also you can schedule a private investor meeting with myself if you want to through our website. If you want to send an email, I'll be more happy to jump on a call or respond. However you'd like to do that. So Tom, great conversations. I hope we could do this again, soon. I believe this is valuable insight for the marketplace, and I really do appreciate your time. Thank you, guys.